Welcome to the Deep Dive. Today we are really taking a close look at, well, a fundamental transformation happening right now in the U.S. power market.
Yeah, it's massive.
We're using the Q3 2025 results and the strategy of a major energy player as our lens here. A company that seems to have cracked the code on meeting this almost vertical demand curve.
That's a good way to put it. It's not just quarterly earnings we're unpacking.
No, it feels more like the blueprint for how the grid is being rebuilt.
Exactly. Our mission really is to dissect how they manage this dual strategy. It's pretty sophisticated. You've got this huge, stable, regulated utility, Florida Power and Light, FPL. Think of it as the financial bedrock, runs super efficiently, brings in reliable capital.
Right, safe pair of hands.
And then you have NextEra Energy Resources, NEER. That's the growth engine, the really aggressive builder out there in the competitive market.
Okay.
And their whole game plan seems laser focused on capturing this, frankly, unprecedented surge in electricity demand.
Yeah.
Mostly from data centers, big industry.
And just to set the stage, that dual approach, it's working financially.
Oh, yeah. Big time. The Q3 2025 snapshot. It's incredibly strong. Adjusted earnings per share, EPS, jumped almost 10%.
9.7% year over year, up to $1.13 from $1.03. That's significant.
It is. And what's really key is where that growth is coming from, because it proves the model works.
Right.
Year-to-date adjusted EPS is up 9.3%. Healthy, but look at the split. FPL, the stable side, added 8 cents per share.
Okay.
And NEER, the growth side, added 6 cents.
So balance, both engines are firing.
Exactly. It gives them the confidence to say, hey, we expect to hit the top end of our EPS guidance right through 2027. They see the pipeline. They know they can build it.
Okay, let's dive into that demand piece, this golden age of power demand the sources mentioned. I mean, is it really that dramatic?
Compared to the last couple of decades of pretty flat demand, yeah, it is. It's structural. What we're seeing is this huge customer shift.
Driven by?
Mostly these hyperscalers, the giant data center operators, building out AI, cloud infrastructure.
And these aren't small projects.
No way. We're talking tens of billions of dollars per project. And they don't just need power. They need hundreds of megawatts, sometimes gigawatts. Reliable, constant power.
Okay, I think we got to talk about the bottleneck here, because that explains the urgency, right?
Yeah.
A company like that needs power, they go to the local utility.
And they ask for an interconnection, yeah. But that's where the old system kind of breaks down.
How so?
Well, the traditional utility planning cycle is long. Years, often, to build transmission, generation, these hyperscalers. They needed that power yesterday.
So they can't wait in line.
Exactly. The sources say they're increasingly trying to secure their connection by, bringing their own generation. Finding partners, developers who can build dedicated power plants right alongside their data centers, basically sidestepping the huge interconnection queues.
So the edge isn't just price anymore, it's speed to connect, bypassing the whole queue.
That's a huge part of it. This kind of environment, it just massively favors the big players, developers with deep pockets, national reach.
The ability to move fast on land permits.
And crucially, the balance sheet. You need to be able to commit billions now. Your small solar shop or regional gas developer, they just can't play at this scale with this kind of technological need.
Which brings us to, I think, the most surprising part of this whole story, nuclear power making a comeback in Iowa, driven by Google. This is where it gets really interesting.
Yeah, this deal it's a landmark. It just shows how absolutely critical, reliable baseload power has become.
So what's the deal?
NextEra Energy Resources signed a 25-year power purchase agreement, a PPA, with Google.
A guaranteed contract.
For 25 years. And this PPA makes it possible to recommission the Duane Arnold Energy Center. That's a 615-megawatt nuclear plant in Palo, Iowa.
Hold on. Duane Arnold. That plant closed, right?
Yep. Shut down August 2020. Now they're bringing it back, aiming for Q1 2029, maybe even late 2028.
Wow. A 25-year deal for a plant that's been shut down and won't be back online for, 4 or 5 years?
Yeah.
That seems slow, risky, compared to building batteries in 18 months.
It seems slow, but you have to look at the type of demand. AI, cloud, they need power, 24/7, 365. High capacity, always on. Intermittence alone can't do that.
So nuclear provides that firmness.
Exactly. And the deal structure takes out a lot of the risk. NEE is buying out the minority owners, taking 100% ownership.
Cool.
Google gets the reliable, carbon-free power it needs for its massive Iowa operations. And NEE, they get really strong financial returns, especially with the policy support.
The policy angle. What are we talking about? Tax credits?
Big ones. The nuclear production tax credit from the Inflation Reduction Act, that gives huge long-term certainty.
Okay.
Plus, because Dwayne Arnold is in what's called an energy community, basically replacing fossil fuel jobs, it gets an extra 10% bonus credit.
So you stack those credits, plus the Google PPA.
And suddenly, a plant that was uneconomic is now looking like a really solid investment, a cash generator.
And it's not just the company benefiting, the local impact. Over 1,600 jobs, maybe $9 billion into the local economy.
Huge local impact. And for NextEra, the plant's expected to add up to 16 cents to annual adjusted EPS on average for the first 10 years.
That's some serious long-term visibility.
Definitely. And it's not just about this one plant. They also have this other agreement with Google.
Right, looking at advanced nuclear.
Yeah, exploring advanced reactor designs, potentially SMRs, small modular reactors for deployment elsewhere in the U.S. They're being cautious, limiting financial exposure for now.
Smart, given the tech is still developing.
Right. But it shows they're positioning themselves as the go-to builder for that next wave of firm, clean power.
Okay, let's swing back to NEER, the competitive side. If these big customers need power now, but the best long-term stuff like nuclear takes years, how does NEER actually win the business today? What's the strategy?
They call it the hook and anchor approach. It's actually pretty
Yeah,
clever.
hook and anchor.
It's basically a phased approach designed to grab the customer immediately, lock them in, and then build out the perfect long-term solution.
All right, walk me through it. Big tech company needs, say, 500 megawatts, needs it interconnected in 3 years. What's phase one? The hook.
Phase one is all about speed. That's the hook. The customer's immediate pain point is getting that interconnection date nailed down. So NEER uses stuff it can deploy super fast. Solar, sure, but especially big battery storage projects.
How fast are we talking for storage?
They can get a utility-scale battery site up in maybe 16, 18 months, and they're doing a ton of it. Originated 2.8 gigawatts of just battery storage deals in Q2 and Q3 25 alone.
Wow. Okay, so that gets the site secured, gets the interconnect locked, customers happy.
Exactly. It hooks them, keeps their own construction on track. The relationship is secured.
Okay, so storage is the quick hook. Then comes the anchor. Sounds more permanent and maybe more expensive.
Definitely the long-term play. Phase two, the anchor, is bringing in the serious baseload generation behind that initial quick fix.
So after the batteries are humming,
then you build the foundation, the high load factor stuff. We're talking new, efficient natural gas plants, or looking further out, maybe that SMR technology.
small modular reactors again.
Right. They already have a pipeline of about 20 gigawatts of gas-fired tech ready to develop.
Let's pause on SMRs again. For people used to giant nuclear plants, what's the quick version of why these are different?
Think smaller, safer, and crucially, factory-built. Instead of massive, bespoke construction sites, you manufacture modules in a factory, ship them, and assemble them.
So faster, cheaper, less complex construction.
That's the goal. Lower cost, quicker deployment. Which is why NextEra is already looking at putting maybe 6 gigawatts of SMR capacity on their existing nuclear sites like Point Beach and Seabrook.
Sites that already have licenses, infrastructure. Makes sense.
Does. Saves a lot of headaches.
The scale of all this, the pipeline sounds huge. Do they actually have enough projects identified?
Seems like it.
Yeah.
The sources say NEER keeps about 1.5 times the project inventory needed to hit their development targets through 2030.
So they have a buffer. Reduces the risk they can't find sites or get permits.
Right. It de-risks their growth plans significantly. And one more policy thing to remember?
Tax credits again.
Yeah, the timelines. Wind and solar credits phase down around 2030. But storage and nuclear, those credits run much longer, maybe through 2039.
So that gives them long-term certainty for the anchor part of the strategy.
Exactly, a massive edge when planning these huge, long-lived assets.
Okay, we've talked a lot about NEER, the growth story. Let's talk about the foundation, the engine block, you called it. FPL in Florida, the regulated side.
Yep, you can't understand the success of NEER without understanding FPL. Its operational excellence is what makes the whole thing possible. It's a cash machine.
How much are they investing down there?
FPL's planning about $40 billion over the next 4 years, just in Florida.
$40 billion. Wow. What kind of projects?
Big stuff within the regulated system, like 5.3 gigawatts of solar, 3.4 gigawatts of battery storage, steady, predictable investments with guaranteed returns.
And the performance is there.
Oh, yeah. Top-tier reliability, almost 60% better than the national average. But the killer stat is efficiency.
Right. You mentioned this. Their bills are low.
Typical residential bills are actually 20% lower than 20 years ago, adjusted for inflation. Why? Because they're non-fuel O&M costs.
Operating and maintenance.
Right. Those costs are 70% lower than the U.S. average utility. 70%.
That's incredible. How does it feed the NEER side?
That massive efficiency difference, that frees up capital. It strengthens the balance sheet for the whole company. That's money and borrowing power NEER can then leverage for those big competitive projects nationwide. FPL proves they can execute efficiently at scale.
Makes sense. Okay, regulated utilities mean rate cases. They've got one happening.
Yep, a proposed 4-year settlement covering 2026 to 2029. The key number is the proposed allowed return on equity, the ROE.
Okay, what are they asking for?
The proposed midpoint is 10.95%. There's a range around that, but that's the target.
And for someone not deep in utility finance, why is that 10.95% number important?
ROE is basically the profit margin regulators allow the utility to earn on its investments. It needs to be high enough to attract investors to keep capital flowing for infrastructure.
So 10–11% is seen as healthy.
Yeah. For a stable, low-risk utility, that's a solid number. It signals financial stability. FPL's actual reported ROE has been higher recently, maybe 11.7%, so locking in near 11% is good for predictability.
And the decision on that is coming soon.
Expected around November 20th from the Florida Public Service Commission.
What does it mean for customers if it's approved?
Pretty modest bill increases, actually. Projected around 2% per year from 2025 through 2029. Very manageable.
And FPL isn't ignoring the big customer trend either.
No, definitely not. They're also pushing for 2 new tariffs, new rate structures, specifically for large customers in Florida.
Targeting who?
Customers using 50 megawatts or more with at least an 85% load factor.
85% load factor. That's running almost constantly, right?
Yeah, that screams data center or heavy industrial user, someone drawing huge amounts of power very consistently 2047.
So even the regulated side is positioning for that data center boom if it lands in their territory.
Absolutely. They want to be ready. #outro. So when you pull it all together, the big picture, the key takeaway is really resilience through versatility.
How so?
This company, it's kind of uniquely set up. It combines that FPL, financial fortress, stable, efficient, generating cash with NEER, which is this aggressive national developer.
Best of both worlds.
In a way, yeah. They don't have to bet on just one technology. Renewables, storage, gas, nuclear. They have the expertise and the balance sheet to deploy whatever the customer needs.
Especially these huge hyperscalers who need it all and need it now.
Exactly. That ability to offer the whole menu is a massive advantage in this market.
That flexibility really is the competitive moat here. And seeing a decommissioned nuclear plant brought back by a PPA with Google, it just confirms this huge shift, doesn't it?
It really does. That old line between clean energy and reliable energy, it's blurring fast.
The market just demands both now, all of the above.
Right. And delivering that takes immense capital and deep technical know-how. Only the biggest players can really do it consistently.
Which leaves us with a pretty provocative thought for you, our listener. If the future absolutely demands firm, reliable power above all else, and if tech giants are now effectively bankrolling new or even recommissioned generation, well, how many other retired or aging power plants across the country might suddenly find a new life, meeting the demands of this next tech revolution? Something to think about.